All right. Well, welcome everyone. Good morning and or good afternoon, depending on where you find yourself in the country today. Thank you for joining us here at Composition Wealth. We have Matt Dmytryszyn, our Chief Investment Officer, Rusty Haas, our Head of Equities, and myself, Nate Angelo, Head of Wealth Management here at Composition Wealth. And we're excited to dive into what I think will be a dynamic conversation about what we're seeing in the markets. I think most importantly, we want to give you context for what we're seeing, give you some thoughts about where things are headed from here, but also talk about the application. And I think oftentimes we find ourselves in dialogue or we're watching various entertainment on TV, i.e. news networks or other organizations, or reading through industry rags that are giving us broad-based strokes as it pertains to what's happening around us. I think the headlines like to really point to the negative that might be out there and or might be on the horizon. But I think we want to bring a little bit of context to what you're seeing, what you're reading, what you're hearing, and most importantly, the application to each of us as individual investors as we think about today, but most importantly, the midterm and longer term prospects of where things are headed in the market, and always looking to tie that back to the financial plan. As you know, we firmly believe in financial planning, and we really do believe that the plan gives our assets, our resources, purpose. And through that, we're excited to dive into what we're seeing in today's world and today's markets. So for the course of conversation, we have call it 20 or 25 minutes of dialogue to kick things off. We're hoping that we get engagement from you, the audience. You'll see at the bottom of your screen for Zoom, there's a Q&A button. If you want to hit that as we're talking and type in a question that comes to mind that you think would apply to a broader group or something that others might benefit from, please type that in. I'll weave it into our question and answers. We have an hour blocked. We'll take as much or as little time as we need and there is interest for this conversation. So let's jump right in. The part of this conversation as we kick off, there's really kind of three big components to it. We're going to first talk a little bit about the economy, what's going on at a high level, what are we seeing in the news relative to tariffs, and how do tariffs impact the economy. We'll then talk about market dynamics and what are the trends that we're seeing, and what's the impact or sort of the other side of this tariff trade war dialogue. What does that mean on a go forward for the markets? And then at the very end, we'll talk about what does it mean to be an investor right here and right now, and not losing sight of the long term. So with that, Matt, why don't I turn it over to you to get us started and maybe level set for us what we're seeing, what we're reading, and what we're hearing about relative to tariffs.
Yeah, thanks, Nate, and good afternoon, good morning, everybody. Appreciate the opportunity to kind of talk through how we're thinking about things. And so the first slide I wanted to share is so first of all, as we look at it, we're really trying to approach things from an apolitical viewpoint. We recognize there's strong opinions on either side of kind of what's going on in some of the policies coming out of the White House. Our view is at the end of the day, when we're looking at how to assess the economy and how to assess the investment environment, we've got to look at that from a range of scenarios and look at the facts as they're coming across, think about how those can play out in different scenarios, and then adjust accordingly. And so it's kind of Robert Rubin, the old Treasury Secretary under Bill Clinton. He's kind of uses the phrase, you got to respond, not react. Reacting being immediately, responding being you have the ability to take time, think through things, and respond in a logical manner. And that's kind of how we're trying to go about that. So as we frame what's going on out of Washington, we first kind of start with, well, there's a number of different policy objectives that are trying to be achieved. Let's kind of boil it down to a couple of the primary ones. So the first one is highlighted here on the chart, is really a goal of the administration to try to extend some tax policies and reduce the deficit. So how are they going to go about in doing that? So the deficit currently sits around about $1.8 trillion. The tariffs that have been announced to date, the 10% across the board tariff would generate about $400 billion worth of revenue. The additional country-specific tariffs would generate an incremental $250 billion roughly. So $650 billion of tariff revenues based on what has been announced to date, really kind of through April 2nd. Then there's the DOGE effort, which has kind of, the administration has kind of said they're targeting $500 billion. When we just kind of look at the numbers and the facts, right, there's about, right now, the federal spending is about 7 trillion. Half of that is kind of already earmarked. The half of that is really, well, sorry, about 4 trillion of the 7 is kind of already earmarked, Social Security, Medicare, and the like. So that leaves about 3 trillion of discretionary spending. Of that 3 trillion, 1 trillion is actually just interest payments. So that really leaves 2 trillion left. And of that 2 trillion, about 1 trillion is defense and 1 trillion is non-defense. So you put it in that context, 500 billion, is going to be kind of hard to cut, but that's their objective. And their objective is to get there by 2028, not necessarily in 2025. And so those get offset by some of the spending plans. So the Tax Cuts and Jobs Care Act, which is about $480 billion worth of tax revenue that got relieved through the Tax Cuts and Jobs Care Act, that would effectively be deficit neutral as it stands today. But the way the budget process works is it got authorized up through this year. If you're going to extend it, you've got to be able to show that that's deficit neutral over a 10-year time period. So the administration is going to have to find some way to do that. On top of that, there's 350 billion of proposed additional cuts that the administration has talked about. So no taxes on tip revenue or no taxes on Social Security and the like. And so those are the moving pieces that if all of this played out as outlined, which seems less likely, there'll be moving pieces, you get to a deficit of about 1 trillion with the long-term goal. So Scott Bessent, the Treasury Secretary, has kind of talked about this 3-3-3, and the 3%, one of those 3 is a 3% budget deficit, which would be about $900 billion. And so getting in close, the flip side is these are all moving pieces, right? So if the administration gives in on some of the country-specific tariffs, and you don't get that 250 million, maybe that means you can't quite have as much of tax cuts, or maybe you need to find more expense cuts, or maybe there's going to be you're not going to be able to hit your deficit target. And so we look at that as kind of one of those those are all the things that are kind of the moving pieces that are going on with the government as they stand today. The other piece is obviously the first 650 million is the tariffs. So what is kind of going on with the tariffs? So going into 2025, the average tariff was 3% across the board. Most of that obviously on China from what was put in through the first Trump administration in 2018 and 2019. Following April 2nd, that tariff rate went up to close to 25%. It's about 23% and change at the moment. So about a 20% increase. The market obviously expected it to go higher. We knew there was going to be an announcement on April 2nd. We knew tariffs were going to go higher, but kind of the expectation was probably somewhere around 15% would have been the average tariff. So this was a surprise, caught most people by surprise. And that's really what led to a lot of the volatility and the downturn in the market kind of following that April 2nd announcement. To put this magnitude of tariffs in perspective. So the U.S. imports about 14% of the GDP comes from imports. So it's there. It's not an overarching driver of the economy, but it's not insignificant either. The rule of thumb, kind of rough math, is for every 1% increase in the tariff, it would have about a 0.1% or 0.1% detriment to GDP or the economic growth. At the same time, it also would have about for every 0.1% or 1% increase in the tariffs, it'd have about a 0.1% impact on inflation. So if tariffs stood where they were at as presented on April 2nd, so a 20% increase, that would hurt GDP growth or economic growth by about 2%. We came into the year thinking US GDP would grow by about 2 to 2.5%. So if tariffs remain as is, we're looking at about a flat economic growth picture. Now, I would like to believe some of those are going to be negotiated. I would like to believe they're going to be negotiated down as we look out and try to look through the policy of the day. Some of those tariffs that were put in place were for policy reasons that were non-economic. So the administration has been upfront. The tariffs that have been put in place on Canada and Mexico are to try to help manage the importation and reduce the importation of fentanyl into the country. And so, I think the obvious uncertainty around this is, well, is that long-term, that tariff rate going to go lower or not? We don't know, but that's one of the things we think about as we think about the range of scenarios that could play out. Separately, on inflation side of things, right? We hit 3% inflation at the end of January. The last 2 months, we've actually seen a deceleration in the rate of inflation. So U.S. inflation over the last year has now been 2.4% if you look at the consumer price index. So if you now do that simple math of every 1% increase in the tariff has about a 0.1% impact on inflation, that would mean we'd have about a 2% increase in inflation if tariffs remained as they were at. So now inflation gets to 4.4. That's high. That's more than the Fed wants it, but it's still much, much less than half of kind of where we peaked in 2022 when we got to 9% inflation. So it's an inflationary impact. I think the expectation by many economists, and the Fed's kind of sits in this camp. Jerome Powell yesterday, when he was talking to the Chicago Economic Club, kind of even hinted at this. This would probably be like a one-time reset. I think that's probably a logical baseline to think at, but what we don't know is the follow-on effects. Do workers sit there and say, hey, wait a second, my prices went up, I need a raise, and if we have low unemployment, it's probably a little bit harder to not give that person a raise if you want to keep them. We have high unemployment or higher unemployment, you have a little bit more power on maybe not raising wages. And so there's a lot of things that are intermixed here that could lead to a wider range of outcomes. And so as Rusty and I look at the framework going forward, we have this grid of various different scenarios, and we think about what could play out, and if it plays out, how would the market react, how would the economy act, and how would we position portfolios with that. The last piece I'll talk on this is just on the dollar. So this is another piece of the administration's objectives, is to help manage the direction of the dollar. So focus on the gray line here. This is the real trade weighted dollar index. Well, what does that mean? Well, in economic terms, real is just inflation adjusted. And so all that's taken into account is how inflation in the US has evolved since 1973 versus another country. And the way we weight that, because some currencies of the US may strengthen versus one country in a given day versus the currency of another country, it may weaken. They weight that by where our trade is. So if more of our trade's with Vietnam and China, we're going to put more emphasis on those currencies when they create this index. And so what you can see is on a real trade-weighted basis, the dollar is the strongest it's been since 1985. And so the administration's view is, hey, if we could get a little bit of a weaker dollar, that makes it more competitive for U.S. manufacturing. There might be greater interest for imports. Prices may be more competitive between U.S. manufactured goods and foreign manufactured goods. And so their objective, and they've explicitly stated it, is to have a weaker dollar. And so that also plays into our thinking, again, on the economy and the positioning. The flip side is kind of from, I would say the standard economic textbook would be is if you increase tariffs, that's likely to strengthen the dollar. That's what happened in 2018 and 2019 when tariffs were imposed in China. The tariffs went higher, but you ended up with a stronger dollar. That actually helped to offset some of the tariff impact, a good chunk of it actually, where consumers didn't really feel a big pinch. This time around, if we have these tariffs and if the dollar were to weaken, which it has thus far, it's down about 8% on the year, that could play into that mix and start to make foreign goods a little bit even more expensive. So a short term could have an impact. Longer term, it could have a positive impact just because it does make U.S. manufacturing a little more attractive.
Hey, Matt, let me ask a question. A question came in. It's written as which countries are in the country-specific category when you, on the previous slide, it notes country-specific category. I guess let me reframe this a little bit in the sense that not all countries are created equal in this tariff conversation. Maybe you want to highlight or break apart which of these countries, maybe are more pertinent than others as it pertains to impact longer term and at the center of the bargaining sort of table, if you will, relative to negotiations. Obviously, China, I think, sits on its own. Maybe unpack a little bit. What's the rest of the world look like?
Yeah. So China, a decade ago, really pre the first Trump administration, was about 25% of U.S. imports. Today, it's around 13%. And so the tariffs that were initiated under the first Trump administration kind of were a contributor to less imports coming in from China. And so China is still important, but much less so. Vietnam actually took a lot of that share. So Vietnam is a pretty significant trade partner with the US, as is Mexico and Canada. And I think below that list would be, Europe and Japan as well. So, but I think those first four, China, Vietnam, Mexico, and Canada, are some of the bigger trading partners that are going to have a more significant impact.
Great. So you set the landscape for tariffs. Now let's talk about downstream impact into economy. And, I was reading this morning, I think in our internal, comments within within our own organization, Matt, you mentioned American Express reported today. So they were reported yesterday, reported earnings, but they also, talk about and are a pretty good indicator for at least a subpopulation of spending trends, right? And or, spending challenges if that's the case. And I think there's this assumption that we're marching towards recession and the consumer is getting weaker. But if you actually look at the data that they shared, things are actually up. And so you look at, 6% growth in build business, 7% growth in, travel and entertainment, 8% increase in, restaurant. The one thing that was, maybe lower growth than what we had been seeing, and definitely I think validates slowing in airlines spending, has been down. Yet 11% increase in first class and business class travel, meaning some of the, call it more affluent people are actually traveling in a more costly manner. So maybe just as a segue from tariffs into economy, that's a little bit of a backdrop in terms of what American Express is experiencing and seeing. Talk about where are we headed as an economy, or where are we and where do we think we might be headed? And maybe you want to provide a little bit of a spectrum of what's possible.
Yeah, I'm really glad you brought up American Express. I think it's a great real-time headline. So, and I'll say the one caveat to American Express is they do tend to skew towards more affluent customers. So you have to keep that in context of their, but all those numbers, Nate, you clearly read through the earnings release today. So nice job on that. All point to really good things. And so, and what American Express said today too, is that's continuing into April. So on a literally real time, up to this minute view, the economy hasn't decelerated. The other thing that came out today was consumer spending. And so there's the retail spending. And what you saw is it was much stronger than expected. It grew 1.4% on a month over month basis. What that really means is that's probably annualizing at about a 15% annual growth in spending. We don't expect it to keep up at that level, but that's a really strong month. But where the strength was in autos, it was in sporting goods, and it was kind of in categories where you would expect more of the tariffs to be there. So I do think we're seeing some element of that strong consumer just being a pull forward of demand. I'm going to buy my car right now. I'm going to need some auto parts. I'm going to pull that forward. Nate's going to get all of his Nikes for his summer running season right now. He's not going to wait until June to do that. And so we're starting to see a little bit of that. So that's kind of the question of how much of this strength is true current demand versus that pull forward. This chart I have highlighted here on the screen, and this is dated, it's as of March 15th, but it's still pretty good. It's like air traffic through March 15th was kind of spot on with past years. You were still seeing it strong. Now, I will say more data we've seen in the last week or two shows, I would say between March 15th and April 15th, you've probably seen a low single-digit year-over-year decline in air traffic. So to your point, Nate, yes, you're actually seeing still strong demand for those first-class seats, but at the back of the plane, it's starting to ease up a little bit, not materially, but a little bit. The chart on the right here looks at weekly retail sales data. That's what I kind of quoted today. That's still pretty strong, and we're seeing it, but we're tending to see it in more specific categories, like I mentioned, in certain pockets, especially where there's maybe expectations of tariffs. The other thing, and I'm going to jump ahead here for a second, as we kind of think about the economy, one of the areas we do see as a risk is that high-end consumer. So American Express validated right now it's in case. So go back to 2023. We, as well as most economists, said, wait a second, the Fed started hiking rates in mid-2022. You can't hike interest rates by 5% and not have any sort of economic impact. So the thought among the broad swath of the investment community and the economic community was back half of 2023, we're going to have a recession. It's not going to be bad. It'll be moderate. And what do we see? Those are the two strongest quarters of growth for the U.S. economy in 2023 were the third and the fourth quarter, when everybody expected a recession. Well, why was that? Well, this chart here highlights it. So this red line is spending among high income consumers. And what happened is that if you recall, 2023 was a great year for stocks. Home prices were up. 2024 was a great year for stocks. Home prices continued to remain higher. So high-end consumers are looking at their balance sheet going, things are pretty good. I don't maybe need to save as much. I used to save 10% of my income. Maybe I'll just save 5 and I'll spend more on travel. I'll spend more at restaurants. I'll spend more going to ball games. And that's what you saw. And the flip side is middle and lower income. You've seen kind of flat level of consumer spending. So our concern going into the year before the new administration and their policies came into play was, what if we start to see, if we saw any decline in asset prices, does that lead higher income consumers to pull back? And is that going to slow the economy? What we're seeing real time today is that has not taken effect. But that is in the back of our mind, is if we do see continued pullback in asset prices, do higher end consumers pull back? And does that maybe magnify some of the downward pressure on the economy in addition to what's happening with tariffs?
Well said. So, Rusty, I'm going to bring Rusty into the conversation here. I think if I were to summarize, all the headlines I see, whether it's on, television networks, whether it's, reading in the Wall Street Journal or other publications, recession and or percentage likelihood of recession continues to tick up. What we've just talked about would not necessarily suggest that is a foregone conclusion. And what is not talked about at all, and I don't think that this is necessarily, and I think, respectfully for all of us, I don't think we think we're going to end up in a world that is, what global free trade, which could be the complete opposite end of the spectrum of recession. But I do believe that there are some potential there is a positive landing for this. And so I guess, Rusty, I'd be curious to get your take as someone who spent 2 decades building a institutionally, managed firm on global equities and knowing the global landscape. I guess I'd be curious from your perspective as we head into markets and market trends. What are your thoughts on, the likelihood or potential of some of this negotiation landing in a place where we do have some pretty favorable trade situations out of these negotiations? Obviously, it's not tomorrow, but is it 2 months from now or 6 months from now where some of that happens? And what are the impacts to the market and what are the things you're seeing as a result?
Yeah, thanks, Nate. I think the positive or how this could all play out that could result in a positive outcome is more negotiated country to country trade deals. So the sequencing does matter, though. Maybe I'll start there. The sequencing does matter. And I think the question came in and Matt answered it, but half of the trade deficit is effectively China plus Vietnam. Vietnam is very reliant on exports, whereas the Chinese economy is not as reliant on exports. So who was the first country to the table to negotiate a deal? Vietnam. So I do think that what could happen is the European Union as a whole could negotiate a large trade deal. That's going to take time. I don't think that happens in 30 days or 60 days or maybe not even 90 days. But I do think that is a potential positive outcome. And that would be really around non-trade barriers, right? So the tariff rate for Europe on US products is not very high. It's really the non-trade stuff, whether it's regulations or other hidden costs to trading with European countries. That could be a positive potential outcome. And then I think, when you think about the global supply chain and manufacturing base, which is, now it's in China, has shifted a little bit to Southern Asia and Vietnam, that there is an outcome in which a lot of that supply chain and manufacturing comes to the Americas and not necessarily in the United States. I'm not suggesting that, but we could become much closer with Mexico, more politically aligned. Obviously, the distance factor, there's lower costs with transportation, and Mexico has an incredibly deep and integrated supply chain and manufacturing base already that we could build on. So I don't expect any real positive outcome with China per se, but I think the rest of the world we could coalesce around a free trade like agreement. And that can still lead to some manufacturing coming back to the United States, especially at the high end, and fulfill kind of the goals of the administration of filling some of those those high end jobs. So we'll see how it all plays out. I think, as Matt said, we're apolitical about this. We're trying to be open-minded and think through different scenarios, both positive and negative, and position client portfolios to benefit.
Great. So maybe let's dive into what are we seeing in the equity markets, and maybe you could give us just perspective on where things sit today from a overall market equity performance standpoint, and then we'll dive into some of the trends and things that we're seeing.
Yeah. So actually, can you go to the next slide, Matt? Or the next slide. Okay, so I think this is important just to think through. And what this slide shows you is the green line is foreign ownership of U.S. stocks, and the blue line is U.S. ownership of U.S. stocks. And so one of the things that's been interesting to see over the last 5 years is really this idea of American exceptionalism, the Magnificent Seven, AI, which which a lot of the innovation started in the United States. And this attracted a lot of foreign capital. So when you talk about U.S. outperformance or valuation multiples of the U.S. stock market relative to the rest of the world being much higher, a lot of it is because we've seen the flow of foreign capital into the U.S. stock market. So big picture, U.S. stock market is roughly 60 trillion in capitalization, and about a third of that, or 20 trillion, is owned by foreigners. And so that has really enabled us to finance a lot of the startup companies. A very deep capital market is very important for innovation and so forth. But that has, kind of run its course, I think, in many ways. And a lot of that concentration, obviously, is in the mega cap part of the market. But there's a lot more to the U.S. economy. It's the most diversified economy in the world. So there's a lot more to the economy than just the top 7 tech stocks. And we see opportunity, outside of tech. So, broadly speaking, in client portfolios, we have taken that weight down in our tech exposure. And, there are a lot of places to look. I mean, a company, if you want, something in tech or tech adjacent, you can think about Netflix. They're going to report today after the close. We'll see the numbers, but in a tough economy or a sluggish economy where maybe tariffs are having an inflationary impact, that $15 subscription to Netflix seems quite reasonable, and probably they probably don't lose many subscriptions. Capital light business, you think about a Netflix versus a Disney. I think Disney might have some risk with high prices at the amusement park side of the business. So we really like a company like Netflix as an idea. Another business that we own is Waste Management. Kind of a sleepy, not talked about company. Up year to date, very well run. You can imagine that waste collection, management, and disposal, that business is resilient to any slowdown or recession. They've also made a great acquisition. We think of a business called Stericycle that will benefit from healthcare disposal. And so, there are businesses and there are companies to own that are not in that top 7 that we think will do really well in any economic environment, and we'll see how this plays out.
So let's, on the next slide, Rusty, maybe you and or Matt, whoever wants to dive into this, just talk a little bit about some of the trends that we're seeing. This idea of higher rates for longer. Put some perspective around that.
Yeah. So this is a long-term chart of the 10-year Treasury yield. Obviously we've been in a declining rate environment for the last 40 years. And there are a variety of reasons for that. One of them is the dollar, and the dollar being the world's reserve currency that enables us to borrow cheaply. And as that has helped rates come down. The other part of this is, as global trade expanded, those low cost manufacturing countries basically outsourced or exported, deflationary or disinflationary dynamic. And so that enabled rates to come down as inflation wasn't really an issue for 40 years. That obviously with COVID, was sort of an abnormal drop, and now, we're kind of back up. And there are a lot of reasons why we think rates stay higher for longer. One is, the global trade. Global trade actually peaked in 2006, and has been declining for 15, 20, almost 20 years now. So that is inflationary by its very, very nature. Another inflationary pulse is the demographic trends in this country. So as people retire, you go from being a producer to just being a consumer. That by its very nature is inflationary. So there are a lot of reasons to think outside of the current administration policy and tariff policy that inflation was going to be stickier, and that meant that rates would probably stay higher. And by the way, if you look at the slide, for 20 years, rates to the 10-year was on average 5 to 6%. That's and the economy was able to manage through that and grow just fine. So one way to kind of think about this is who benefits from a higher rate environment. We like insurance. This is a sector that is not as well owned. It's not talked about in the press or media or even on Wall Street as much. But if you think about a big beneficiary of higher rates are insurance companies. Insurance companies make a spread on their insurance business, but then they also have long-term investments. And a lot of those are in fixed income products. So as rates move up, that part of the business benefits. It's also sort of in a hidden inflationary hedge. If you think about property and casualty and insuring, think about your car insurance, insuring a car, and as that car price has gone up over the years, it costs more to insure that car. So as asset prices move up, the cost to insure those assets also moves up. And so that's also a beneficiary of insurance. So there are ways to benefit from this change in interest rates. And again, it's not all about tech. There are other things and other pockets of the market that we like, and we see a lot of opportunity.
Maybe to take that a step further, Rusty, I mean, insurance fits this theme of higher for longer really well. It's a nice inflation hedge. But when we look at other themes in our portfolios, like obviously our artificial intelligence is going to be a nice long-term secular trend. Insurance is an industry where the underwriting and the claims process has a lot of administrative burden at manual process. That's not going to be fixed in the insurance industry overnight. But we think AI over a 5 or 10-year period could have a meaningful impact on the margins there. On top of that, when we're facing these tariff pressures, insurance companies aren't really directly impacted by that. So they kind of also kind of have a beneficiary of that. And as more geopolitical issues they're a little bit more transpire, they're a little bit more isolated from that.
Yeah, that's a really good point. And just to add a little bit on that is, thus far AI and the focus on AI has been, Chat GPT and, basically a replacement for more traditional search. But as AI starts to proliferate in businesses, that's where we think we'll see the real impact. And that's where, there's this interesting dynamic of higher costs related to tariffs and other things, but the ability to create more efficiency. And that is through the application of AI at the corporate level.
So a great place for me to ask a couple of questions here. So I'm going to combine a couple of questions that are coming in conjunction with some things that I'm sort of reading and seeing myself. So if you just follow the media, it would suggest that most countries are going to be rethinking on a go-forward basis whether or not they can continue to see the United States as the place of strength and safety, specifically when we talk about treasuries and the fixed income market. My personal view, I'm not the investment expert, but my personal view is I'm not sure that gets unwound, overnight. I think that because it's on a relative basis, right? And you have to look around the globe and you have to go, how stable are other monetary systems? How stable is their government? How stable are their decision-making processes? How stable is their economy, et cetera, when it comes to those decisions? But a couple of questions here. Will international holdings in US bonds affect yield rates or maybe I should change the question to say if the trust in the US should decline at some point or at some, rate that might be, rapid in nature as defined by you?
Yeah, I can start, and I know Rusty will have some things to add on this. I'm in agreement with you, Nate. I think at the end of the day, the US dollar is so entrenched in the global economic system that it's not going to be ripped out immediately. Oil is quoted in dollars. And the flip side is, well, where else are you going to go that's going to have the stability of that and the scale and liquidity of that? And that doesn't exist today. So could this be a slow, gradual transition? That's definitely a possibility. But at the same time, there is. I mean, I think one of the things we're cognizant of, and Rusty kind of showed it on the slide earlier, 30% of the US equity market is owned by foreign investors, or 20%, I'm sorry. 30% of the treasury market is owned by foreign investors, which, by the way, is down from 55% in 2008. So that's been cut up nearly in half, but that hasn't had a material impact on the functioning of the treasury markets or yields. And the international investors own about a third of the corporate bond market. So we're cognizant of that. And then in the bond market side of things, you tend to hold the bond to maturity. Yes, you could exit all of your treasuries today, but if the US dollar is weaker by 8%, that hasn't helped your return. And if I know I have 5 or 10 years till that bond matures, I might want to think twice. Do I really want to liquidate it today, especially when some of these changes are politically driven, and in 4 years from now, we could be in a different political position. So I don't think that's going to happen overnight, but it has entered our thinking. So one of the areas that we're more intrigued by is international stocks and bonds. And part of that is if we do have a weaker dollar, that's actually better for when you're taking your dollar and converting it to a foreign currency, getting that return and returning it back to dollars. On top of that, we do think that there actually could be some benefit to, like Europe. We're seeing a little bit more of a unification, a little more of a pro-Europe stance within the continent. And that can be a positive for the economy. And for the first time in quite some time, we're actually seeing growing budget deficits, which, for a shorter period of time can be a good thing. And that can be stimulative to the economy. And so we're seeing that as an opportunity. And so you started to see us in where it's appropriate in portfolios, moderately start to increase the international allocation.
Yeah, I would just add that the currency moves can add or subtract materially to your return. So a European investor investing in the US over the last 10 years, I think, was up 1,000%. 40% of that came from currency. So stocks were up 60% or six times, but the currency made up the difference. So these currency moves can magnify your returns one way or the other, and we have seen the dollar weaken by 8 or 9%. That may continue, but to Matt's point, I don't think it unwinds quickly. It may unwind over a 10-year period, and maybe we get another 5 or 10% decline from here. But that actually just kind of neutralizes the playing field a little bit. If you go back 30 years, 20, 30 years, when the euro was first created. So, I think the market will absorb that. It also just, brings the point about diversification, why diversification is so important. And, I think people were questioning, why do you need to own anything outside of the US given the last 15 years of outperformance? I think it's really important to stay diversified.
So on that point, this idea of safety. And so, let's talk about safety. Let's talk about cash-like equivalents, and maybe let's just use instead of talking about this in the abstract, let's talk about how we think about it and express it in our portfolios where we have, either some positions in cash, some of it's strategic because of where someone might be in their life cycle, and they're using that bucket of money for future spending or near-term spending. Is our U.S. Treasuries, or Treasury-like or short-term bond, highly rated short-term U.S. bonds still a good place to be? How do we think about, safety as it stands today? And is safe being redefined in front of our eyes?
Yeah, the demand for treasury bills has never been higher. One of the changes that's really occurred over the last several years, so as the Fed started raising interest rates, the US Treasury made the decision to issue less notes, which are really bonds longer than a year, and issue more bills. And so it used to be about 20% of the treasuries issued were in bills, meaning treasury bonds that were a year or less in maturity. Now it's close to a third. And that supply has been just sopped up by the market. And so there, because you're getting a higher yield on your cash rate, the demand for it is there. And so we're not really worried about that demand in the bill side going away. Now, when you talk about treasuries, you look at from a 1 month treasury all the way to a 30-year treasury. So when we go on the opposite end, I think that's the area, even before what happened with the tariffs, and really for the last year or two, we've been kind of discussing, could the market get to a point where it starts to say, wait a second, I'm less comfortable in the US's fiscal situation, that I'm going to expect a greater yield and a greater return to own a 10-year or 30-year bond. And we haven't really seen a ton of that yet. And it's just because that treasury market is so liquid. And again, I go back to foreign investors used to be 55% of the treasury market. They're 30 today. And over the 15 years that they've been kind of reducing their allocation, we haven't seen this notable uptick in treasury yields as a result of it. And so I think the demand is there from pensions, from individual investors. And we've seen individual investors, as rates have been higher, get back into bonds where they might not have been when you only got 1.5% on your 10-year treasury bond. So not an area that we're overly concerned about. That being said, we recognize concerns around the deficit. Could we see 10-year treasury yields, yielding 0.5% more because people are concerned about that? And I don't know that we know the answer to that, but we definitely think it's a possibility. And so as we look at portfolios, we actively think about how much of that do we own versus do we really want to own versus, and so it's a balance. So right now we're a little bit underweight that segment of the market because we're a little bit worried about those risks as we see things play out. We put that in a kind of a range of outcomes perspective. So we think the 5-year treasury should be, somewhere between 4.25% and 4.75%. Right now it's yielding 4.3, so it's at the lower end of that. So don't think you have more risk of rising rates. In that case, we're going to own a little bit less of it. All of a sudden we wake up tomorrow and we've got a 5 or 6% yield on a 10-year treasury, we might be more constructive and feel like that risk is priced into it.
Yeah. So let's flip the conversation on its head now. So we've been talking about safety. We've been talking about fixed income markets. Let's talk a little bit about, I'll use this in jest. I was informed this morning apparently that the Mag 7 is no longer a thing, but we all know what the reference to the Mag 7 and what it represents. Jensen Huang is on his way, or probably is now, in China, going to talk about a number of things relative to NVIDIA. Taiwan Semis had earnings the other day, very strong numbers. I think the go forward might be a little softer maybe, but did deliver some pretty good numbers. As we think about China and Taiwan specifically, we think about, chips. How do we sort of unpack, and again, obviously two staples when we think about Taiwan semis and we think about NVIDIA. I know there's other firms in the space, there's other firms that are working to create chips, but they're sort of at the tip of the spear. How do we think about China, Taiwan, chips, AI, tech going forward based on what we're seeing today?
There's a lot to unpack there. So yeah, Taiwan semiconductor. Well, let me back up. Semiconductors are the modern version of oil in the 70s. Semiconductors are in everything. Semiconductors power everything. Semiconductors are at the leading edge in AI. Taiwan Semiconductor is arguably the most important company in the world because they're the only company in the world that can manufacture high-end chips, semiconductor chips, at scale. And so one of the important pieces of legislation is the CHIPS and Science Act from the Biden administration, and basically subsidized moving TSMC manufacturing to the US, specifically right outside of Phoenix, Arizona. So that process is in place. But again, these things don't happen overnight. Here we are 4 or 5 years later, and they're now starting to manufacture chips. That was a very, very important move. And I think there are many reasons why TSMC became the company that they are, with what's been going on with Intel over the last 15 years. But that is really kind of at the heart of all of this, and I think that's one of the reasons why you're seeing tariffs, specific tariffs on semiconductors. So what we really need to do as a country is figure out a way to manufacture those high-end chips in the United States. NVIDIA is trying to do that. Now, it's also important to understand that these companies, NVIDIA, Google, a lot of these tech giants really rely on foreign revenue. To the extent it's on average in tech, I think it's 50-60% of revenue comes from non-US sources. That extra revenue allows these companies to invest in R&D, to then continue to move forward and progress and maintain that moat or competitive advantage over the rest of the world. So having that revenue is very important, and I do think people understand that in the administration. So I think at the heart of any kind of deal with China will have to be semiconductors. And Taiwan Semiconductor is manufactured in Taiwan, which is not China, but a lot of the manufacturing of other semiconductor chips is actually in China. And so that's one of the reasons why it's really important. So we'll see how it all plays out. We do have, in terms of chip design, we have some of the most advanced chip design in the world. We often talked about China needing 5, 6, 10 years to catch up with chip design. I think with DeepSeek and some of the other AI models that we're seeing, they're a lot closer than we think. And I think so. This is a very competitive market, and I think at the heart of all of this tariff talk is what happens with semiconductors.
Yeah, that's great perspective, Rusty. And I think one thing you said in there that I think a lot of people said could never happen, and maybe they didn't use the word impossible, but they leaned into that, was that you won't see one of these firms like TSMC or NVIDIA ever create chips in the United States. And so the fact that Arizona did happen, and while 4 or 5 years to you or me seems like a long time, that actually is like defying odds in terms of where people thought TSMC or NVIDIA or any other chip maker might be. Candidly, if you would have said that 5 years ago or 10 years ago, when these ideas were first being talked about, there was a lot of skepticism about the reality of that coming to fruition. And so I guess what I would just say here is, as we think about the broader context, I think it is a good data point to keep in mind just about how dynamic both the United States can be, but also how these companies can function and operate and continue to push the envelope forward in a very dynamic environment. A couple things before, as I know we want to wrap up here in a couple of minutes. I think it's really important, and I think we've done an okay job on in this conversation of trying to express some of the views and or tweaks we're making in our portfolios. We talked about insurance. We've talked a little bit about the fixed income market. Because I think sometimes these conversations can stay at such a high level that the investor, or in this case, our client, walks away without understanding the application and what's happening inside the portfolio. And how is it that your portfolios have continued to perform well, not only hold up, but in many cases supersede relative benchmarks. The other one that I think is of interest, that I think applies to today's day and age and the consumer, is what we're doing relative to our position with Amazon. And so maybe just as a last little practical nugget, Rusty, you just want to speak to, this is not market timing. I think we want to be very clear. We are long-term investors. We fully believe in staying invested, but obviously making tweaks when the market gives us opportunities to do that. And I think the Amazon one is another good example. If we could share that as one of our last practical examples of something we're doing in in the equity side of our portfolios.
Sure. Yeah. So we had a big position in Amazon, and when we kind of looked at the Magnificent Seven, we were equal weight Google, overweight Meta, and overweight Amazon. No position in Tesla, And then Nvidia, we had been overweight and underweight, so it's bounced around a little bit. We've been underweight Microsoft and Apple. We were underweight Apple and no exposure to Tesla, specifically because of their reliance on China for manufacturing. Regarding Amazon in particular, we thought, that their AI business was and their advertising business were two big growth drivers for Amazon, and so we really like those businesses where their core e-commerce business would continue to take share and continue to do well even in an economic slowdown. However, with the China trade war, we did take that position down, and we're now equal weight or slightly underweight relative to the benchmark because of the potential impact on their supply chain with China. So, still like the business, but we had to take some of that position down because of the risks with their reliance on China. And we'll see how it plays out. I mean, as the facts change, I think we'll change our mind. But where we sit today, we're hopeful that they can, it's a very dynamic company that they can continue to change their sourcing from China to other countries. But it is still a big reliance on China. So we just need to see how that plays out.
Great. So two quick hit questions, and then we'll wrap up and we'll with two more slides, just pointing to rational thinking for investors. Quick question. You guys decide, or who wants to take which one? Defensive moves to preserve capital. So the one thing I'll say here, it's not necessarily just moving to cash. But as we're thinking broadly here about markets and where we're at today, if someone's in a capital preservation situation, how would you just sort of give them a 30-second thought on portfolio positioning?
Yeah, so I can take that one. I mean, obviously, if you're in a capital preservation, that's a good situation where we, as an advisor, can help you figure out what's the right asset allocation mix for you, right? And that's dependent on the individual. So it's hard for me to answer that question more broadly. Cash plays a role, but I think in an environment like this, we have to keep in mind, you can get about 4-ish, a little over 4% on your cash right now. I just told you earlier we could see inflation a little over 4%. So on an inflation-adjusted basis, your cash might be holding flat. Bonds are giving you more yield than that. And so bonds, and if you hold bonds to maturity and we don't have any defaults, and that's our aim in our portfolios, you're able to actually get that yield and lock it in when you go into it. And so I think in an environment like this, bonds can play a role. And bonds have tended to work as a nice hedge in economic downturns. And we actually saw that earlier this year. And so as we started to see some of the market jitters around the tariffs and what could happen even before April 2nd, we saw bond prices move high. We saw yields go lower, which led to higher bond prices and helped to offset some of the impact of those equities going down. And so it's kind of a broad question, but I think we can work with you on just that diversification aspect of, guess what, by the way, international stocks are positive this year, whereas the S&P is down. And so building a portfolio where we can kind of have good diversification and focus on that capital preservation.
Well said. Who wants to share their view on gold as a portfolio component based on the current environment and the threat of the dollar further weakening and increasing of inflation?
Yeah, I can start, and Rusty, feel free to pile on. Gold is tricky, and I'm going to speak for Rusty because we share a similarity in that we're cash flow investors. And gold is always tricky because you don't get any cash flow out of it. So there's no real good way to value gold. And so gold is what I would call more of a technical or sentiment trade. And it's dependent on, do people like it or not? And this year, it's loved. It's loved because it's been a nice little hedge. But even before we've had some of the volatility of the last few weeks, gold was seeing a nice uptrend because you had central banks buying gold. And central banks have chosen to do that. Now you've had a pretty strong inflows of ETFs into gold. So an interesting chart, when you look at kind of the ratio of the price of gold to the stock market, it's at an all-time peak in favor of gold. And so it just shows that there's massive sentiment into it. A side comment is gold's volatility is the same as stocks. If you look at gold over the long term, and I haven't looked at this number, call it in the past year, but historically gold gave you about a 4% average return with about 15% standard deviation, which is a similar level of risk or volatility as you'd get in stocks. but the return was about half or less than that of equities. So as a long-term investor in gold, it's hard to get that comfortable in gold. On top of that, because so much money is moved into gold, the downside risk, I would say, is elevated at this point in time. That being said, I can't tell you where sentiment's going to go and how people are going to feel over the next month or 3 months. Gold could double in the next 6 months. I don't know that. But what I know is, given how stretched it is relative to other risk assets, it does feel like the downside risk is above average. So, Rusty, I'm not sure if you have more you want to add.
Yeah, I would just add quickly that I think one indicator of gold prices will be what the Chinese central bank does. So the Chinese central bank is not buying U.S. treasuries, so they can buy euros. So the Chinese central bank can do a few things. They can buy U.S. dollars, they can buy euros, or they can buy gold. If they're not buying U.S. treasuries, they've been buying gold. And they're the biggest buyer in the world of gold. So I think if you want to, just kind of follow along what they're doing to see maybe as an indicator of what happens to the gold price, that would be what I would recommend. But I agree completely with Matt. We're cash flow investors. There's a cost to owning gold versus something that provides you cash. And so, it's always a little bit of a tricky one.
And to your point, Rusty, actually, the Chinese central banks now actually more recently started buying oil in addition to it. So there's other alternatives beyond gold at the moment.
Yeah.
Well, Matt, if you don't mind putting up the last two slides, we'll close and be respectful of everybody's time this morning. What we're experiencing or have experienced to date in 2025 is well within the historical range. And if you look back at the very highest line on this chart in 2024, last year, when we had incredible, gains in the markets, we saw a 5 to 10% drawdown. The year prior, another very strong market return year, 2023, 10 to 15% drawdown. And here we are in 2025, and we're at 15 to 20%. Are we done yet? We don't know. Some people believe the bottom is in. Others, don't think so. We're in the camp of we'll see where we go from here. But we think there's equal upside opportunity, and there is also the downside that still exists. I think it's also important to note. Remember in 2020 when the Fed came in and started buying, they started buying at the bottom. Didn't know it was at the bottom at the time, but there's an opportunity here for investors that are mid to long term in nature to continue to reposition portfolios, use this as an opportunity, engage with your advisor, and tie it back to your financial plan and the outcomes that you are looking to create for yourself, your household, your family, and your next generation, if you will. And then the last slide we'll close with the old saying of, when you try to time the market, you don't have to get one trade right. You've got to get multiple trades right. You've got to get in and get out, or you've got to get out and get in. And it's not easy to do, especially when you look at the blue bar on this chart and the power of staying fully invested. Because what happens is you move to the right when you miss the 10 best days of the market. And one of those examples just happened not that many days ago, when you had an end of the week come, the market shoots up by almost 10% in a day. You miss days like that, it has a drastic impact on the portfolio, and more importantly, the plan that is guiding your financial journey. And so with that, we will wrap. Matt, Rusty, thank you so much for spending the hour today. Thank you all to our clients who have joined us. We appreciate your trust. We hope you found value in this. If there's anything you need, please feel free to reach out. Stay tuned. We'll be doing this again here in the next 6 to 8 weeks. We also have a conversation coming up about the power of a friction relationship between a CPA and a financial advisor. So more content to come in the coming weeks. Thanks again. Have a great day.